Stocks suffer big losses amid investors' concerns over shifting monetary policy and rising economic risks due to inflation. The Dow Jones Industrial Average plunged over 3%, while the broad-based S&P 500 index slid nearly 3.5% on Thursday. And the tech-rich Nasdaq Composite Index tumbled 5%. The fall of the three main Wall Street benchmarks erased gains made a day before. That's when the Federal Reserve approved a rare half percentage point interest rate increase as expected, but ruled out a three-quarter point raise. However, investors remain worried that the Fed's hike would not be enough to tame inflation, which has soared to over 8%, the highest since the 1980s. Jack Rasmus is a professor of political economy at St. Mary's College, joining us from San Francisco. Jack, welcome. If you can, please break this down for us, and how do you view the economic outlook in the United States?
Well, the Fed has clearly decided recession. That's been baked in. The only question is how soon, how deep, how fast. The U.S. economy contracted in the first quarter here. And apologists are saying, oh, well, it's all due to, net exports trade and consumer spending's good and so forth. Well, they're going to soon get a nasty surprise. If you look at inflation going on, it's accelerating in the U.S. It's a perfect storm. Less than a year ago, the economy opened up. Well, we got some demand pushing prices up. But then we got a big shock from global supply chains that drove prices even more, and domestic supply chain problems in the U.S. and transport and so forth. So that added, that supply problem, which was the bigger contributor, added to inflation late last summer. And then we got the large monopolistic corporations who started price gouging based upon it. On the inflation, even though there was no shortages in their particular industry. A good example is the U.S. oil industry. There's no shortage in the U.S. domestic oil. However, what's happening in oil is that the U.S. Oil companies are producing about 2 million barrels less a day than they did in 2019. They got it. It's in the ground. They don't want to add the drilling, the drilling of more of a, drilling operations to bring it out of the ground. They're leaving it there because it keeps the prices up. So there's no shortage there. The same with bakery companies and food and bread and so forth. These are monopolies in the U.S., and they're using the existence of some industries with a supply problem to price gouge everybody, and the Biden administration is doing nothing about it. Well, that's not the whole story of inflation. Now we see on top of that, we've got the Russian sanctions, which are driving commodity prices up all across the board. That's a third force. And now it's just been reported that productivity is collapsing in the United States. We have the worst productivity figures in 73 years just came out. Companies raise their prices based upon unit labor costs rising, and they're rising fast because productivity is falling fast. So we got another wave coming, a wage inflation, actually productivity inflation, coming on top of that. And all these other waves have not subsided here. So we're going to have a massive increase. It's already over 10%, not 8% inflation. It's going to go higher. That's cutting into consumer spending big time. And you're not going to have real spending here over the summer increasing, and that's going to knock the bottom out of GDP going forward.
Right. I mean, Jack, the Federal Reserve, the role of the Federal Reserve, we see negative public views towards the central bank, its bailout of other large banks, for example. Does the Fed serve Americans or the banking sector? And then just a follow-up question to that, in the limited time we have, the knock-on effect that this could potentially have on normal households already suffering from high inflation, high prices of goods and services.
The Fed is supposed to be raising rates to do something about inflation. Well, the Fed raises short-term rates, that's supposed to have an impact on demand, but the problem isn't demand, the problem is supply. So the Fed is not going to have any effect on really reducing inflation unless it precipitates a major recession, as it did in 1981-82. This is deja vu. The Fed is going to take a supply problem caused inflation out on the backs of consumers and households by bringing the economy to a halt in manufacturing and in construction and in small business lending. This is the strategy, to take it out on demand, which really is a supply-driven problem here. So the Fed isn't going to have any effect very much on inflation. It's going to cause a deep recession. It's only a question of how deep and how soon, with the economy already slowing in the United States. Is it going to have an effect on consumers? You bet it is, big time.
Interesting. Jack, thank you very much indeed for your thoughts there and your contribution. Jack Rasmus is a professor of political economy joining us from St. Mary's College out of San Francisco.